Coming up, the gender pay gap narrows. We take a look at Rio Tinto's workplace culture problem and training in the workplace, how it can boost your pay. All that and more next. It's your daily 10-minute business and finance news wrap for this Wednesday, the 20th of November 2024. The Australian share market fell today by 0.6%. We'll have the details with Stuart Roberts from Stocks Down Under, and we'll take a closer look at Rio Tinto's workplace culture issues which surfaced today. But first, to the gender pay gap, where the government's Workplace Gender Equality Agency says the pay gap has decreased to 21.1%. But when you include CEOs, the first time the report's added senior leadership, that expands to 21.8%. And that means for every dollar a man earns, on average, a woman makes 78 cents. For more, Tyson Cusey spoke with the CEO of the WGEA, Mary Wooldridge.
So what hasn't changed is that we still see that men are 1.9 times more likely to be in the highest earning band than women are, and women are 50% more likely to be in the lowest earning wage group. And these are the inroads that we need to make to ensure that we can change and narrow the gender pay gap. The good news is that the reduction that we've seen today has been driven often by those low-paid workers increasing their wages at a greater level. And so particularly residential aged care workers, but also retail industry and the accommodation and food service industry. So we have to work across the board, getting more women into higher paid roles, but also balancing those lower paid roles and making sure we can increase the wages to narrow the gap.
And how much of a role do you think primary care leave has played in closing the pay gap?
So paid parental leave is a really important indicator of the culture and the support for equality in an organisation. And we really need to shift that norm that we have that women do the caring and men don't. And in many cases, men do want to and expect to play an active and equal role in their parenting. So we have seen an increase in the proportion of employers who are offering paid parental leave, and now 68% of them do. We've also seen an increase in the proportion of men who are taking that paid parental leave in terms of the uptake of it to 17%. So of all the primary carers leave taken, 17% has been taken by men. And that we really want to encourage to increase because what we know is that when men take parental leave, not only is it very positive for them in terms of that engagement and connection to their children and their families, but it fundamentally shifts that dynamic on an ongoing basis, creating a more equal sharing of that caring responsibility, which helps enable women to return to work should they want to, as well as men participate in the caring. So shifting that culture, shifting the dynamic, supporting men to take parental leave is a really fundamental part of creating equality in the workplace and at home.
Okay, and just lastly, I know you mentioned, that there is that sort of shift in workplace culture, but executives are predominantly still men. What do you think can be done to close the gap even further? Do you think things like quotas need to be considered?
Well, exciting news today as well is that the government has introduced a bill into Parliament that will require large employers to set targets to make progress against them in terms of improving their gender equality. And that can be the composition of their workforce, it could be the composition of their board, putting in place things like paid parental leave policies if they haven't got them already. And so we do need to continue the momentum to accelerate change and narrow that gender pay gap. And things like the publishing of the gender pay gaps that we did earlier this year of individual employers brings transparency and accountability in action. The new legislation, if it's supported by the Parliament, will enable further action in terms of target setting, and we have to make sure that there's pipelines and opportunities across the board for women at the most senior levels, leading organisations and all the way through.
That's Taza Cusey there speaking with Mary Wooldridge, the CEO of the WGEA. Well, now your pay could increase dramatically by taking part in work-related training programs, but fewer people are engaging in them, down 14% on 2007 levels. The Committee for Economic Development in Australia says even those in training are spending less time participating, with time constraints identified as a key barrier for both workers and employers. That's despite the potential for greater staff satisfaction and increased productivity. For more, I spoke with CEDA's Head of Research, Andrew Barker. That 20% increase in incomes, how is that coming through?
So that's coming through by the year after training. So some of that increase comes in the year when they do training. They can do training anytime during the year. So it comes across a couple of years, but that's looking at the same person over time. Their incomes are 20% higher once they do training. And as mentioned, when we compare against otherwise similar people who aren't doing training, they're not getting that same boost over time. And that's people need to keep doing training to keep their incomes up. They don't sort of get that increase forever, but it's a considerable boost when people start doing training.
Your research also showed, though, that the work-related training is declining. Why do you think this is, especially at a time when this type of training is increasing around the world?
That's right, Ricardo. So work-related training participation is down 14% over the past decade and a half in Australia. And the type of training with the most consistent downward trend is training to build skills in the current job. So that's concerning. We've heard that employers might be concerned that they'll train people up and then they'll go and work for a competitor, take their skills somewhere else. But when we look at the data, people are actually less likely to leave after they do training. What we think might be behind this decline is the challenge of making time for training in amongst all the day-to-day work that everyone needs to do, the chance to build skills for the long term. So people feel like they can't make space for training, but our work shows how important it really is. One other possible explanation is we do see an increase in training for compliance reasons, so to meet relevant legislation and regulations. That can be really important to protect safety, but if it's not done well, it can also crowd out space for training that builds skills.
Okay, so you mentioned there that restriction on time. What else can employers do? And what about employees? Can they ask for training, for example?
So employers need to really build a learning culture within the organisation. We show how important it is for productivity, and that means making time for training in rostering and freeing up space so people can engage in training. They also need to better measure the return on investment. We found in a questionnaire that only about 15% of firms properly measure the return on investment from training, and that's challenging, but there are ways that firms can better look at the outcomes after training and the quality of the training that they're developing, and better measuring the return on investment for different types of training can help target better things like compliance training, where they need to make sure that people are not doing repetitive training that's not necessary, doing things like evaluation to make sure that you're not doing more training when you've already got those skills. For employees themselves, they need to be given the bandwidth and take the opportunity to recognise the considerable income growth that training can provide for them, and to take responsibility for their own development pathways and working with their managers to build the skills for the careers that they want.
That's CEDA's Head of Research there, Andrew Barker.
Now, Market Day on the SBS On The Money podcast.
The Australian share market fell today. The S&P ASX 200 down by 0.6%. A slight rise in Rio Tinto share price. Its executives have apologised to staff over workplace culture reviews, which found instances of unacceptable and harmful behaviours and attitudes in the mining company. Just over 10,000 employees took part in the survey, which found 7% experienced sexual harassment and racism over the past year. That's the same as in 2021. There was an 8 percentage point increase in bullying behaviours to about 39%. Rio has already implemented strategies to address cultural change, which it says is heading in the right direction. But Rio's report also identified that some men felt there was reverse discrimination, with specific resistance towards programs and strategies targeted at women and other marginalised groups. The report's recommending management explain why differential treatment is necessary to level the playing field for all. Here's a bit from Rio Tinto Australia CEO, Kelly Parker.
I certainly have mixed emotions about this report. It's distressing to know that people are still in situations where very bad, disrespectful behaviour is occurring across sexual harassment, bullying and racism. And that is sad, and I feel sorry for anyone that's experiencing that, and I apologise for that. But there is green shoots. People are much more aware about our Everyday Respect program. There's many conversations that are occurring around respect, and people are starting to talk about the change, and we know that they're talking about the change because we're seeing backlash. And when people are feeling like there's a change, they can resist it, and that's the first thing that they can feel, and that's what they're telling us. So we know that we're pushing on something here, but we have to now meet people where they're at and stay the course.
That's Kelly Parker there, the CEO of Rio Tinto Australia. And for more on that story, plus the day's share market moves, I spoke earlier with Stuart Roberts, an analyst at Stocks Down Under. Stuart, the ASX slipped from a record. Why?
Well, the Trump trade is about a month old now, or it's getting a little long in the tooth. So I think it had to ease up at some point. I also think that markets are a little worried that the interest rate cuts that we've been expecting will never come. We were expecting it this year. Now most people expect it in February. Some of the pessimists are expecting it in June. So it's like the market is collectively throwing up its hands and saying, we'll just work with what we've got, rather than wait for interest rate cuts.
The European conflict has entered its 1,000th day today. To what extent are global geopolitical tensions really hitting the market at the moment?
Well, you've seen it in the recent re-rate in the price of gold. That's got to be a trend that will continue into 2025. The way in which things are hotting up in Ukraine at the moment has the markets a little bit worried, but not excessively so. The incoming administration, I believe, is working on some plans that could potentially ease things down around the world. So you balance those two together. It's not freaking people out, but it continues to be a worry.
Any company news you're keeping an eye on today?
The Amcor transaction interested me. We're talking about a company that's now a global leader in packaging. Now, packaging is an industry with much sex appeal, but we need it and we consume a lot more of it. So if you're big in the space and you cover all of the elements of the packaging industry, from flexibles through to rigids, and you can execute as well as Amcor has, then any acquisition's got to be good. So I think this Berry acquisition is worth paying attention to.
Yeah, and I think that's a $13 billion deal valuation too. Can I get your thoughts on Rio Tinto? Today, it released the findings of an external progress review on workplace culture. It showed while there's some perceptions that workplace culture has improved, it still noted that a number of people are suffering from bullying experiences, racism, and that there's improvements still to be made in workplace culture, especially when they're trying to implement diversity, right? I'm just curious for your take on that, if there's a shareholder experience, what investors think, because this also comes at a time when other organisations like Nine Entertainment, for example, also went through some issues with workplace culture.
Yeah, time was when markets didn't worry about this and just cared about revenue and EBITDA, but those days are long gone. Anytime there's a hint that the company is not handling these kind of workplace culture issues, then people want to know more, because you don't know what talent is going to walk out the door and take a lot of potential shareholder value with them, just in terms of what they could contribute. There's a lot of published studies that good ESG and diversity-focused cultures can attract good people in. Now, you don't want to go overboard with that. People have got a job to do. But I think increasingly we're going to see people focusing on getting companies out of their portfolio that mismanage that sort of stuff. Generally, it's where there's one individual who's doing the wrong thing that could potentially blow up a lot of shareholder value. When it simmers beneath the surface, the decline in shareholder value is a little bit less pronounced, but it's something that people care about.
And finally, where do you see the opportunities for investors at the moment?
So tech is where it's happening in 2025. The Trump trade has had a big tech focus, thanks to some of the people in Silicon Valley that potentially benefit from the incoming administration. And that's got to be good for Australia's tech sector in 2025, particularly as we come up to those interest rate cuts, which I'm hoping are still going to happen in February of next year.
That's Stuart Roberts there from Stocks Down Under. This SBS On The Money stream is provided for informational purposes only. The content in this stream should not be understood as constituting advice or a recommendation. It is not personal advice and it does not consider your personal circumstances or objectives. You should contact a licensed professional before making